Warning. This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Right, hello and welcome to Camel Finance. I'm your boy Camel, and things are heating up, and I'm looking forward to being able to show you exactly where they are heating up. Before we get into today's episode, I have said a few times that it's been an idea of mine, an expectation, that I don't think retail is coming back this cycle. And when I say that, I don't necessarily mean at all. I just mean possibly not anywhere near the level that we've seen in prior bull runs. And it's important to understand, it's just an idea, it's just an expectation, it's not even really part of the base case hypothesis. Whether it happens or not is neither here nor there. I don't think it really changes much, but it's just been an expectation of mine. It makes sense in my mind. And the reason I say that is largely because I think the conditions and circumstances today are quite different to prior tops. I think we've suffered a great deal of inflation. I think that most people are starting to lose their jobs as unemployment creeps up. I also think that the higher interest rate environment has meant that many people are struggling to service their debt and their mortgages. Credit card debts are at all-time highs and all of this kind of thing. And I just think that when you compare that to the prior cycle, at least, where everyone was changing careers because of the lockdowns and the pandemic era, when everyone was locked in their house and bored, when the hype was real at Bitcoin at the time, potentially going to 100K, or that was the story. We had Elon Musk going on Saturday Night Live. There was the laser eyes epidemic. And moreover, people just had more money, okay? We hadn't suffered the level of inflation that we have in the past 4 years, okay? So in my mind, it makes sense that we're not going to see retail come back because they're too busy trying to put food on the table and they don't really care anymore. And many of them have been burnt once or twice before by crypto or some altcoins. And that's been my idea. Okay, now, if I'm flat wrong about that, I'll hold my hands up and say, there we go, I'm flat wrong. It really makes no odds. Like I said, it doesn't really matter in terms of the base case hypothesis. But I thought that asking ourselves this question right here might be prudent for some of us, okay? I saw quite a lot of comments yesterday saying things like, well, Camel, if retail doesn't come back, then how on earth are we going to get higher prices? Who is it the institutions are going to dump on, right? And the absolute truth of the matter is, retail has never really mattered, okay? Retail size is not size. If you think that these big institutions can offload multiple billions of dollars onto retail, I mean, you know, the people don't have that kind of money. Retail come in with a couple $100 here or there, and even if there's millions of them, then that still doesn't amount to one large player exiting a position on all of retail, and particularly that retail spreads that $200 or $300, $1,000 at the most through, you know, 3 or 4 different assets. The truth is, retail has never actually mattered. But to answer this question of who is it that the institutions are going to dump on, right? Where is the exit liquidity? Who is the exit liquidity? Then I think the answer is quite simple, okay? We probably are the exit liquidity here, okay? And if I ask you the simple question, what percentage of market participants make money over the long term? You already know. You already know the answer that on a good year in a roaring bull market, we could maybe expect 70-ish% of retail clients to lose money, okay? And during more stressed conditions, during less blow-off toppy, less cyclical bull market top kind of zones, we can expect up to 90% of market participants to lose money over the long term. And keep in mind, the long term for most retail, okay, most non-institutional traders, is around 3 years. As I often say, most people come into this space, they have a career expectancy of less than 3 years before they blow up, quit, and come to the conclusion that the whole thing's a scam, or that TA doesn't work, or whatever the excuse is, right? But given that that's an absolutely known fact, given that it's well established that this game is for the elite and only the elite make money, right? Around 10%, maybe 20 if you're lucky, get to make money, whilst 80% get to lose perpetually. Then when we go back to this question, okay, armed with this new knowledge, it's not even new knowledge because we already knew this, okay, but when we frame it in this context and ask ourselves, who is it that the big boys are going to be dumping on? Well, the answer is us. Okay, that's the answer. And whilst 10 or 20% maybe could walk away with some gains, whilst 10 or 20% of us might be able to sell close to the top, even flip short, okay, and then sit in cash and wait for some opportunity to present, rotate their capital into some nice places, whilst there's a small percentage of people that can do that, the absolute truth of the matter is, okay, most people are going to F this up. Okay, let me say that again. Most people are going to F this up. And what I mean by that, and I have said this a bunch of times, but it is really, really important, is as we start to squeeze higher, okay, as we start to get really blow off toppy, and let's just make the assumption that that is going to occur, we aren't about to just go straight into a recession or some kind of big bear market. So assuming we go higher, the higher we go, the more people have this tendency to look at the open profit in their accounts. The more people have the tendency to pull their phone out and say to their wife, hey, look, hey, babe, we're rich, right? And we've all been there, we've all done it. And let me tell you, when we start to get even more upside squeezes, the majority of people are going to start to get greedy and euphoric. We've all seen the Wall Street cheat sheet, and we all know what is it that's labeled up here before the big bubble pop, right? Something like hope, optimism, and then it's greed right here, and then it's euphoria. Right? And there's a reason for that. That's because when people have made life-changing money in a matter of weeks, which is how long the third angle typically lasts, people do get very euphoric. And herein lies the issue, right? For most people, keep this in mind, like I said, up to 80, even 90% of traders, that includes the people that are watching this video now. Statistically speaking, 9 out of 10 of you, or at least 8 out of 10 of you, are going to F this up. Because once we get here, you're going to not have the experience. This is your first rodeo, your first bull market. You're not going to have the experience to start to think, okay, I'm getting nervous up here because I know that this is coming next. And instead, people are going to start to bet the farm. They're going to start to mortgage the house, get credit card debt. They're going to start to think to themselves, well, I've never traded leverage before, but now seems like the opportune time to start going 50x or 100x leverage to the top, right? That is where the exit liquidity comes from. It comes from people that have done very well, maybe buying in the bear market on the way down, buying through the lows, weathering all the FUD, right? Weathering the storm. And then up to this point, they've made very good gains, okay? DCA in, hold it, DCA in, perhaps hold it. Massively life-changing wealth is here. And it is in this last final hurrah, okay, that people go, time to get on leverage, time to go 100x. And then very quickly, all of the gains that are made in this first section are blown up. And that is who is really the exit liquidity. So when I talk about retail not coming back, like I said, it's an idea. It doesn't really matter, okay? If they come back, it just means we probably get slightly more of a squeeze. But I don't believe the Uber driver and our barbers and the guy down the pub that you told to buy Bitcoin, I don't believe they've got size. I don't believe they've got the type of size, even in aggregate, to let out big players. But what I do think is an important question to ask is, are you going to be part of the exit liquidity, right? I ask myself this all the time because I know full well that, like I said, during these squeezes, it's very easy to get euphoric at the top. It's very easy to start thinking that you are God's gift to the charts, right? And you cannot possibly lose. And that is where all of the mistakes get made. That is where the exit liquidity gets generated, whether or not the Uber drivers and the barbers and whoever else comes into this space or not. So the reason I wanted to touch on this today is just because I know that a bunch of people, this is their first cycle. I know a bunch of people entered during the bear market, DCA down, like I said, or they've only been here for half a cycle, or this is their first full cycle, something like that. And just understand that we've all done it, okay? We've all held gains right up to the top, only to say, well, we'll wait for the pullback, we'll buy the dip. And then the chart morphs into this, and we go, well, okay, it will soon be back, right? And then the chart morphs into this, and you're still holding the bag or still trading on leverage, trying to recoup the losses. And then you say, well, I should have sold at 200. Now it's at 100 or even 70. It seems ludicrous for me to sell at 70. I'll just hold until it goes back to 200. And then, of course, it morphs into this, and we're at 50 or whatever the number is, right? And, and very quickly, you can see how we are the exit liquidity, okay? And 80, maybe 90% of us are going to make these mistakes up here and end up bag holding, end up leveraging, and end up being the exit liquidity. So if you're in this camp of people that sort of sits back and says, I can't wait for retail to come to be my exit liquidity, then perhaps just do a little bit of thinking on this, right? Ask yourself the question, are you prepared to sell? Do you have a strategy? Have you got the experience to not add leverage and size, to not get a mortgage on the house right at 200k Bitcoin, right? Have you got all of these things figured out? Have you internalized this entire process? Are you prepared for greed and euphoria? Because if you've never experienced it, then the truth is, how could you possibly know what it feels like, right? How could you possibly know you're ready to be exiting and joining the big boys and using people as exit liquidity when you've never even experienced euphoria in a market before? So I just thought it would be worth considering this. I hope you found value in this idea, and understand, for as long as I've been doing this, I've traded through many blow-off tops in many different asset classes, and I am still very much aware that it is far easier to say you're going to sell the top and flip short than it is to actually do it. Now, I've got an added complication this time around because I've got to do it on YouTube and I've got to do it in front of an audience that will be merciless if I get it wrong. So this is no easy feat, but that's why we do it at the end of the day. We chose to fake the moon landing, not because it was easy, but because it was hard. Anyway, okay, so I've rambled way too much. We're starting to be silly. Let's get into today's episode. So Cynthia Loomis, I don't think I pronounced that right, said that big things are in store this week, okay? Big with the Bitcoin emoji on the B. So is that something that is going to be a non-event, or is something very big coming? I see a lot of speculation that there's going to be an announcement that they're going to back the dollar with Bitcoin or have some kind of strategic reserve. I don't want to try to predict or call any of that because who knows, right? Who knows? But what I do know is we are expecting a third angle and have been for some time, and a fear-driven fifth catalyst, okay? So in case you don't know what these are, let's just quickly touch on it. First of all, from Tony the Bull here, very nice example of what I believe is the correct count for the Elliott wave system for Bitcoin, right? We have had 1 into 2, into 3, and now we've done this ABC into 4, and I believe what is coming next is the fifth of the fifth of the fifth, okay? The final fifth wave. And what's interesting, and what I keep saying over and over again, is the whole Elliott wave system reflects market psychology. And for the fifth wave of a commodity, which I believe Bitcoin is a commodity, even if it's not, it's certainly more like a commodity than it is a stock. During a fifth wave for a commodity, it tends to be driven by fear. It tends to be driven by the attitude and the psychology of the market participants that sounds like this. Okay, I need to own this asset. I don't care what the price is. The risk here is not owning it, not worrying about what the price is. Okay, a fear-driven fifth wave is what is to be expected. So right at the same time as we just so happen to be about here, okay, and seemingly bouncing out of a weekly cycle, we also seem to be looking for a fear-driven fifth to come in. So that suggests that something is going to show up in the coming days or weeks. It could even be months, but let's say days to weeks, that will alter market psychology to force people into the market with the attitude that they are scared not to own this commodity. So I am on the lookout for some kind of narrative that can force people to say, I don't care what the price is, just get me in. And maybe part of that is to invalidate my idea about retail not coming back, okay? Maybe this narrative is so scary that absolutely every man and his dog decides to take some money out of the bank or get a loan and throw it into Bitcoin because, again, they are scared of not owning it. But that is at least the fifth wave portion of this, okay? And then the third angle is what I prefer to use on the channel. If you've been here before, you will have seen me do this, but just in case you're new, because I know a bunch of people were asking me what is the third angle, instead of this parabolic dotted line that you can see here that Tony has drawn, I prefer to use 3 angles of attack. So I draw one trend line here, and then that is fixed and I can't move it. Then once we set a second one, something like this, I draw it here, and again, it's fixed, I can't move it. And then what I look for is a third and final angle to come in, which is near vertical, and it's upon violating that third angle to the downside, right here is where I will be looking to sell and even flip short, expecting something like this to play out. So my system has been telling me we're looking for that third and final near vertical angle to come in. The Elliott wave system suggests we should be looking for a fear-driven fifth wave. And right around this time, okay, we're seeing things that are allegedly coming this week. We've got the Bitcoin Miami conference. Is it Miami? Don't quote me on Miami, but we've got the biggest Bitcoin conference of the year on Friday. DT is going to be speaking, and again, there's a whole heap of speculation. If it turns out to be a nothing burger, then we might even see a sell-off, okay? Because the market seems to be expecting some big catalyst and some big news to come out of here. As ever, we'll keep taking it one day at a time. We'll keep staying on top of it. But like I was saying, the third angle is expected to show up to force Bitcoin into a near vertical price action. And we also have the Elliott wave system overlapping with this and suggesting that we should be expecting a fear-driven fifth. So potentially very, very, very big things to come over the coming days and weeks. As I said at the start of this video, things are starting to get very, very interesting to me, okay? And I've been talking about perhaps seeing a rate cut show up earlier than expected. The market is currently pricing us for close to 100% probability that we'll see cuts in September. And I keep saying, tell that to the bond market. The bond market, if it keeps moving lower, is telling us we should be open to seeing cuts before. And then out of nowhere, China just made a surprise interest rate cut, only 0.25%, to stimulate economic growth. Okay, so we've seen the ECB, the Bank of Canada, Czech Republic, the Swiss bank, we've seen Sweden, all of these central banks perform cuts ahead of the Fed. Okay, and now what we're seeing is a surprise early cut from China. So is it reasonable to expect that we still might get cuts slightly earlier than September? I think it is. And remember, the central banks don't tend to diverge. A few tend to go first and then the rest tend to follow. And we've seen most of them go now. All that's really left is the Fed for America and the Bank of England. Again, I still think it's quite possible we see them before September. If we don't get until September, that's fine with me too. But again, things are getting interesting here, especially for the Camel Crew. On top of that, okay, a lot of people get this yield curve inversion completely wrong. And people seem to think that the moment the curve goes inverted, that's a signal for a recession. But there's a nuance here, and that nuance is it's not until the thing inverts, reverts, crosses back above the zero line, and then starts to accelerate. That is the moment, once we get above the zero line and start to accelerate, that is synonymous with triggering recessions, okay? So if we go back here, we get the inversion, cross back above the zero line, recession, same here, cross back above the zero line, recession, same here, same here, same here, right? This is what we tend to see. And of course here. So at the hard right edge, if this thing is about to cross above the zero line, and I should make this clear, actually, whilst this chart looks like we have already crossed above the zero line, we're actually not quite above the zero line yet. We're actually much more in this kind of neighborhood, but we're getting close. But again, if this thing is indeed going across above the zero line and accelerate, then it is another piece of evidence that suggests we are possibly closer to a recession than most people are willing to entertain. Wall Street analysts are sitting currently at around 90% of them expecting either a soft landing or no landing. Only 10% of the analysts on Wall Street are looking for a hard landing. And I was talking about this over and over and over again, that nearer the tops, we should expect the proliferation of the soft landing or no landing narrative. And at the same time, I'm still getting almost everyone saying, no way you're getting a top before November of this year. No way that this bull run doesn't at least run into Q1 or Q2 of next year. I still see a whole heap of people saying, no, this is the most telegraphed recession ever. But the reality is, okay, very, very few people are looking for a top this year. This is something I'm going to continue to track. But if this thing starts to accelerate, okay, then it fits with what I've been saying, that by the time the NBER, National Bureau of Economic Research, come out and report a recession, because remember, they are the governing body that are in charge of officially declaring the recession. I think when they next come out and release their recession update, we're going to figure out, everyone's going to find out that we've actually been in a recession for a little while, okay? Maybe it started in June, maybe it started in July, maybe it's just about to start in the next couple of months. But I've been talking about this for around this July-August timeframe for well over a year, maybe closer to 2 years than 1 year. And now we're finally here, right? We've got the Olympic ceremony on Friday. And the more I look around, the more I see these surprise cuts showing up, the more I see inflation is no way as sticky as people believe. We've got a yield curve about to revert and accelerate. The labour market deterioration is continuing to get worse and worse. We've also got the bond market telling the Fed that it will be cutting. And of course, historically speaking, tells us to keep an open mind about seeing some hard times show up in the not too distant future. So again, a wild time to be alive. Things continue to get more and more interesting everywhere I look. Meanwhile, copper has just dropped to a new 3-month low. Again, indicative of a slowing economy. Like I was saying, I think when the NBER releases its recession data, it's going to reveal that the economy has been softening way, way, way more than most people have been aware of. And again, we are still probably going to need to see some kind of surprise rate cuts show up, since the interest payments on the US national debt is eating around 76% of all income taxes collected. Okay, so could this be the fear-driven fifth? Could it be something like this? Could it be some kind of financial collapse, some kind of bank failures, some kind of realization that this is a Ponzi scheme, right? And that this thing is going to collapse. I'm not saying that's what it's going to be, but that would make a lot of sense to me personally. And at the same time, we've got an ETH ETF about to go live. So this was certainly something I got wrong. I'll hold my hands up and say that. I consistently said many, many times, I don't see how they ever get a spot Ethereum ETF approved. But they've done it, so I have to hold my hands up there and admit I was completely flat wrong about that one. Does this pull in market participants? Does this end up being a nothing burger? Do they end up using this just to distribute on the current ETH holders? We're going to find out. And I'm not the biggest fan of the power law personally, but I found this and I thought it was worth touching on, okay? I only really wanted to make 2 points about this. So the power law suggests that we will possibly get a top of around 170 something K by the end of 2025 and a bear market low around 12 months later, around the end of 2026. But the 2 points I wanted to make here were, first of all, if we look at the black line, which of course is Bitcoin's current price action, does this thing not look suspiciously like it's going to top well before the expected right translated top of around the end of next year? It looks suspiciously to me, particularly if we're about to get a third and final near vertical angle and a fear-driven fifth, that this thing is going to reach this number prematurely. And then that also feeds into the idea that we might see this bear market extend for more than the 12 months that we're used to seeing for Bitcoin. Now, the second thing I thought was very, very interesting about this, because there's a whole heap of people calling for Bitcoin's price to make a high wherever it makes it, followed by some kind of big bear market that sweeps these lows. Okay, I see price targets from very big accounts of around 10K, and frankly, I'm not interested in debating that. Well, we've got potentially about 2 years of bear market to all argue about where the thing is going to stop, right? I don't think that's important for now, but I will say this. The power law says $66,900, okay? And to me, that makes perfect sense because it will be right around the current area on the chart that we have been basing during this 3 into the 4, this ABC. So we would be forming right around here. Tony's got it slightly lower. Again, I don't think we need to be worrying about this yet because we're going to have a full bear market to all debate over where the thing stops. But it's interesting to me that whilst a whole heap of accounts are calling for these very, very low numbers, one, I've been making the case that I don't think mining is going to permit the network to do this and recover. And I know a bunch of people say, yeah, well, the difficulty adjustment just moves down, but that's not really how it works in the real world. Yeah, the difficulty adjustment moves, but if we start slashing the hash rate and we go from having the most secure database on the planet to something that's not really any more secure than some of these other proof of work coins, then Bitcoin has really failed at this point, right? Not to mention all of the overheads like the ASICs, the cooling, the power, everything else, that's all fixed. The leverage in the mining sector, which is very leveraged by nature, that's not going away. So I don't think that just making the argument, yeah, well, difficulty moves and then therefore it gets easier to mine, I don't really think that's going to cut it. To me, somewhere in this neighborhood that Tony's got and even slightly higher would make a lot of sense. And I did think that that was quite interesting since the power law seems to have picked up on this as well. Now, another interesting point here, okay, is that people think that if we have this blow off top to a left translated cycle and then an extended 2-year bear market, that implies somehow that because it's 2 years in time, it must be severe in price as well. But cycle theory, I don't know if I've ever mentioned this before, cycle theory does not say just because the bear market is 2 years, right, twice as long as what we're used to seeing for Bitcoin, it doesn't necessarily mean it has to be a long and drawn out and violent 99% drawdown. It could very easily be a left translated cycle that spends most of its time just kind of flagging, making people think we got a double pump coming, and then it rolls over, does about 50% top to bottom. And if it did that, okay, it wouldn't be super insane. If it only went down about 60 or 70%, it wouldn't be crazy for a number of reasons, right? First of all, we went, like 95%, then 85%, then 75%. If we went 65 or 70 here and it took 2 years, would that not just give the big players plenty of time to distribute? Would that not train people to buy the dip expecting a double pump and an up-only cycle? Again, I'm not really trying to pick the bottom here. I think I want to pick the top first. But it's pretty interesting that, like I said, first of all, if we just look at the black, it looks an awful lot like we're ahead of schedule here from the power law top, and therefore a left translated cycle could be coming. And secondly, the power law, the one thing it has been incredibly good at is picking bottoms. And if it can just do the same for the next bottom, again, that tells us about 67K is the low. And I know a whole heap of people would love to become whole coiners at 10K or 6K Bitcoin. There's a CME gap down at 9.7K, I think. I know a lot of people salivate over that, but in my mind, okay, you're locked out. you're not getting 10K Bitcoin. We're probably going to get this 60 or 70K Bitcoin. Anyway, like I said, we'll argue about that when the time comes. The last thing I wanted to point out is oil, okay? We are due a daily cycle low any day now. And notice how we've left behind a weekly cycle low in blue. Now, if this is going to be a bearish trend, which I believe it is, then I think what we should expect is a right translated daily cycle, which is what we've had, followed by a left translated daily cycle that fails, okay, and then another left translated daily cycle that fails into that weekly cycle low. And this would also, of course, kill the sticky inflation narrative, okay? That would make a lot of sense if CPI really is done, if we really are already late to see the Fed cut, if the CPI is going to continue to come off, then this would certainly confirm that. And it would also fit the idea of a slowing economy. The reason I say that, of course, is the slower the economy goes, the less demand for oil and production there is. And thus, if there's less demand, should we expect this thing to roll over? So I am looking for a left translated weekly cycle here for this to remain the peak of this weekly cycle perhaps, and then be looking to capture this short move. I still see a whole heap of people calling for much higher oil prices and a booming economy into next year. Personally, I don't see it. And if I get invalidated on this idea, if we get a breakout and a big run, okay, then I can hold my hands up and say something is possibly wrong under the hood. But if this thing does what I think it's about to do, which is like my yellow squiggle suggests, roll over, fail the cycle and start to trend down, not only do I want to get short here because I missed the opportunity here last time, but it would actually make perfect sense based on everything else I've been presenting during all of these videos. So expecting a bounce here, but again, looking for a left translated daily cycle that both rolls over and fails. So I think it's worth keeping this on your radar, even if you're not going to trade it. I think it's worth paying attention to it. It's also interesting that Nat Gas, I believe, is doing a similar thing here, right? It made this new low. It kind of had this pump, lower high, right? And now it's starting to roll over again. So is natural gas leading on the way down, and is oil about to follow suit? I think it probably is. So anyway, it's just something I'm keeping an eye on, not so much as even a trading opportunity, just because I think it's going to be important to see how it feeds into the slowing economy narrative and to the sticky inflation or not so sticky inflation narrative as well. Bitcoin's still doing Bitcoin things, okay? So happy days there, long and strong, and we'll see what the market can give. I see a whole heap of people trying to get a gap fill. Maybe you'll get it, maybe you won't. For me, I'm not so much interested in the day-to-day fluctuations. Like I said, I'm looking for a big fear-driven fifth and a third and final angle to come in out of here. So long and strong, continue to push there. Gold, I'm keeping an eye on to see if we can get a daily cycle low and even perhaps one more rollover into a weekly cycle. If this thing is going to break out and go though, then again, I know my invalidation and can get long there. Silver is looking a lot more like it's trying to force a daily cycle and even a weekly cycle low. So be interesting to see if we can get some kind of quick flush, something like this perhaps. And then that down here will be a golden opportunity, no pun intended. The stock market, I'm looking for this to be the first drive, okay? So if you're new here, into cycle lows, we look for one of two things. We look for either a V into the cycle low, and we can buy the swing and put the stop below, or we look for, particularly in gold and the stock markets, we look for a two drives pattern. So we get a move down, a counter trend bounce, and then a move down to undercut that low, form a swing, and that is where we mark the cycle low. That is where we like to get long on a swing that's confirmed with a trend line breakout and put the stop just below here. So if that's going to play out, which I hope it is, then I'm hoping this is drive one, counter trend bounce, drive two to undercut that low from 2 days ago, followed by a swing and a reversal, confirmed with a trend line break. We mark that as the cycle low and the long gets put somewhere in here. That's what I'm looking for. That's what I'm hoping for. Obviously, the market doesn't always give you what you want, but if we can get a rollover and an undercut here, then I have a very high degree of confidence that the next swing that forms will indeed be a buyable swing. Kind of the same deal for the NASDAQ. You can already see from my yellow squiggle, I was kind of calling for this counter trend bounce and a two drives pattern. So will we get it? Something like this perhaps makes a lot of sense. An undercut of that low, a swing, and then a trend line break to confirm it. And I think you will see me add a long in here as well. And it will probably look something like this. Dow Jones long and strong. I'm still letting the market do its thing so I can find the chart in the area that I think I need to attach my line to. And the Russell 2K, okay? Russell 2K still doing Russell 2K things, so long and strong there. The VIX, I drew this arbitrary yellow squiggle, and I think something like this is probably going to play out, right? We seem to have got that pop, some kind of rollover here. See if we can get down to 8 or 10. And I think if we can, then by the time we get down there, the stock market should have been completing its third and final angle. We should probably be at around 6,400 for the S&P, I would think. Somewhere in that neighborhood would be pretty good. And then I think if this thing is going to break down, if we really are going to enter a recession and all that other stuff I keep talking about, we should be expecting the VIX to be a tradable position from down somewhere around the 8 to 10 region, and the spike should be enormous. I would be probably looking for 3-figure VIX. But anyway, one day at a time, this is probably a good few weeks, if not months away. And so that's all there really is to it, okay? Things keep getting more and more wild. We keep staying on top of it. We keep doing our best, expecting Bitcoin to do Bitcoin things. Still looking for a couple of cycle lows this week. And of course, if you're a member, look out for the notifications when I get the positions on. Other than that, I hope you'll consider what I said about the whole retail and exit liquidity stuff at the start. I hope you found value here. And until next time, take care from me. All the best. Cheers. Bye.